Hello and welcome to this webinar on financial planning when you have a condition like lupus. My name is Debbie Kinsey. I'm the Health Information Officer at Lupus UK. I know my name says Paul Howard. I'm not Paul Howard. I'm just borrowing his Zoom account for the evening. I'm also joined by my colleague Alida Bennett, who's just providing some tech support in the background, which as you've been on a Zoom meeting or a webinar before, you know that's a very important job to have in the background. Financial planning. There are lots of different agencies and companies you can go to for advice. So I just have to add my little disclaimer that other companies are available. But today we're very fortunate to be joined by members of the Stonewood Group who will introduce themselves very shortly. So they're going to talk through different aspects of financial planning and particularly financial planning and lupus, and focus on the things that people with lupus said was important to them in a survey that we did together over the summer. There'll be a Q&A at the end. I've also had some questions in advance, which is great. Thank you for those. But at any point during their talk, feel free to use the Q&A function to pop your question in, and we will try to get through as many as we can at the end. The webinar is being recorded and it will go up on our YouTube channel at a later date, and we'll advertise on social media when that happens. So don't worry if you miss anything or want to come back to stuff, or you need to drop out a bit early, because you will be able to watch it again another time. So I think that's enough from me and housekeeping. So I will hand over to Ed to introduce himself and the rest of the team.
Hi, good afternoon, ladies and gentlemen. My name's Edward Bieber. I'm the Business Development Consultant for NLP Financial Management, and have been working with lupus for many years, and have worked with our team of financial planners. You may in fact have seen some of our articles in the magazine, or have actually been the recipient of our advice. Well, why do we work with lupus and other health-related charities? Well, it's straightforward: to offer financial advice to people, but because of their illness, they have not been able to receive an appropriate financial solution to their issues. In return, we donate a significant percentage of the fees and commissions earned back to lupus. So it's a win-win story. Now, in 2021, our company, NLP Financial Management, was acquired by the Stonewood Group, hence the introduction with Stonewood. This has led to some very positive outcomes for lupus patients, as the enlarged group, which includes our friends from Group Rapport, also now part of Stonewood, has provided greater resources to more people and to offer an enhanced service. Now, earlier this year, I had a meeting with numerous follow-up calls with some of the senior members of the lupus management team, with the objective of finding out what were the main concerns of people with lupus. This led to a questionnaire being compiled by us, in which we asked people to prioritize these. And as you can imagine, there were many issues. Now, during this webinar, we hope to address some of these issues and to offer you the chance to address any questions to our team. And if we run out of time and you do not have the chance to raise your question, we will provide you with our address and contact details where you can reach one of our financial planners. Now, that's enough for me. I'm going to hand you now over to Rachel.
Hey, and Debbie, if you could share the slides at this point, that'd be great. So my job is simply to introduce the team. As everyone said, we are part of Stonewood Group, and you'll see that there's various different parts of that. On the next slide has our agenda, and I'm just going to talk you very briefly through what we're going to talk about. Who are Stonewood? We've covered that. We are a group of 4 companies that fall within the Stonewood Financial Planning Group. The connection to Lupus UK goes back many years, and it's one that we really hope to add value by offering really sound, holistic financial advice to everybody. The benefits of financial planning are going to be covered by Lev today. We're going to talk a lot about why you should seek financial planning, why it's important to have that ongoing financial relationship. Next point, please, Debbie. Elliot is going to talk about cash flow forecasting, which is a really great way of understanding what your future can look like. None of us have a crystal ball, but it's about helping you look into the future and try and prepare yourself as best you can. Next point, please. We're going to talk about retirement planning. I know that pensions is not everyone's favorite topic, but luckily you have 3 people on this call that do find it fascinating. So we are going to talk about pensions. Next point, please, Debbie. We're going to talk about life cover. This is something that really started the campaign with Lupus, talking about how to get you protection, and Matt is our resident expert on this. He's worked on many cases, so he'll be talking about life cover as well. We're going to talk about the impact on your mortgage, because I think that is one of the really crucial questions we're getting from all clients, and not necessarily Lupus specific now, but that's really important too. Got a lot of questions about that. And then at the end, we'll cover any questions. I know plenty have been sent to Debbie, but also please do ask. You do have a Q&A section at the bottom of the screen. Next slide, please. So meet the team. There are 4 financial advisors on the call today: myself, Elliot, Lev, and Matthew. Matthew is our mortgage and protection expert, and the 3 others, we are chartered financial planners, which I think really speaks to the dedication that we have as advisors to our ongoing professional development. Between us, we have over 26 years worth of experience, which means that between the advisors, we've been working for Stonewood or their associated companies for longer than Matthew has been alive. So you've got a lot of experience here today. Please feel free to use it. And on that note, I will hand over to Lev, who's going to talk to us about why financial planning.
Thank you very much, Rachel. And yeah, I'll talk to you about benefits of financial planning, but I think it's important to start with a bit of history and talk perhaps about some of the experiences some of you might have had in the past, and actually to answer some of the questions I'm being asked all the time. The first one is about general guidance, and what I mean by that is that we would like to become your primary point of contact whenever it comes to any sort of financial planning needs, even if it is cash savings. As you know, cash rates have improved dramatically over the past 2 years. We may not be able to advise you precisely about the accounts to open, but we can certainly point you in the right direction. This is what the financial planner should do for you. Secondly, I'd like to make you aware that sometimes there is a limited choice of products and options. So when you think that you are getting the best product, it may not necessarily be the case. And what I mean by that, if you were to go to, let's say, your bank and ask for the best savings rate, they can only recommend the best saving rate available to them, which of course means that perhaps someone across the street might offer you something better. And again, it's from savings rates, mortgage rates, and investment products as well. The next question, of course, I would like to mention, I'd like to talk about is fees and commissions. As I'm sure you know, there are several articles in the press about advisors charging commissions in the past and charging ridiculous fees, which is a shame, to be honest. But all I'm going to say is our approach is no fees are due until we agree upon the work to be underdone and we disclose the fees to you. So you know exactly how much you're going to pay and you know exactly what you're getting, but I will cover this a little bit later. And the last point, I'm sure it happened to some of you perhaps in the past, pensions being set up for you, or perhaps an ISA, the advisor has done it for you, and then you never hear from them again. So you don't really know what is actually happening, and the number of pensions I'm sure all of us had to go through and actually figure out where the pensions are and what they invested in. So it is crucial to keep an eye on the situation and to monitor your financial position. Which brings me nicely onto the next slide, which is stages of financial planning. We'll start with the initial meeting where we gather information and define goals. And of course, your goals will be quite specific. For example, as Rachel mentioned, we'll talk about insurance, but insurance given your circumstances. So that can be your goal. And we need to make you aware about potential implications sometimes. So you may wish to gift some of the money to, let's say, your children or grandchildren, but there are potential tax implications which you should be aware of. So the initial meeting is really just a chat about what you're trying to achieve and what your financial position is at the moment. Then essentially the advisor goes away, does a bit of research to find the suitable options given your objectives and circumstances. Then we provide you with a report where we recommend a specific product suitable for your needs, including the prices. And yeah, if we can demonstrate that, it's definitely on the slide. Yes, it is. The next stage is if you decide to proceed, then we'll liaise with the providers on your behalf. So it's completing the forms, it's doing the application, it's making sure the policies are in place, it's making sure investments are made at the timeframes as agreed. And where it is applicable, we'll monitor the ongoing situation. I don't think we can see that. Yeah, we can see that point. So, of course, it's only applicable to certain products, but it is crucial to, of course, stay in touch to make sure that the investment or a product, let's say an insurance policy, is still suitable. And the best example would be, is the level of cover still sufficient for your needs? So I think now is the time to actually mention some benefits of using a financial planner. And the main one, I suppose, is time constraints, which simply is who has time to actually go out, do all this research and set everything up. This is what the financial planner can do for you. The second is our expertise, our financial qualifications. Rachel kindly mentioned that 3 of us are chartered, but even to be a standard, if you wish, financial advisor, you have to do at least 3 exams, which cover a wide range of topics. So we can certainly use this expertise to assist you. Emotional detachment, quite important, because at times it does happen we probably holding some investments which should have been sold some time ago for whatever reasons, and the advisor can simply come in and make sure that you holding the best possible portfolio. That's just one of the examples. It's all well and good to have a plan, but you need to see through decisions and ensure the plans are actioned. So yeah, I think it kind of speaks for itself. I keep coming back to this ongoing advice as circumstances change, because your circumstances surely will change in 6 months and 1 year's time. It is our standard practice to see the clients at least on an annual basis, but depending on your circumstances, depending on the agreement with your advisor, it can be 6 monthly, it can be even quarterly. And of course, we're always available on emails, telephones, etc., etc. I already mentioned the fees, but yeah, just to reiterate, no fees are due until we agree upon the work to be underdone. And the fees are disclosed in the report, as I've mentioned previously, so you know exactly what you pay for, exactly how much you pay, and you know why this recommended product is suitable for your needs. And finally, excuse me, as I've mentioned previously, my example with the bank, we're not tied up to any particular provider, to any particular institution. We can research whole of market and recommend the product or investment suitable for you, rather than the only one which is closest to us. As a summary, it's a rather big slide, but I'll just quickly touch on key points, because I'm sure you want to hear about some specific examples, as will be mentioned by my colleagues. I do mention here tax planning. So, for example, we will provide you with necessary tax reports to you or your accountant if needs to be. We can manage the investments for you, so it's asset allocation. We can talk about investments later on if you so wish. Just put the questions in. Financial planning I've mentioned already, but it's also even little things, I suppose, as I wouldn't necessarily call it mis-selling, but I would say making sure that the products you are buying are actually suitable for you, given your health situation, and Matt will talk about it later. Over to you, Rachel. I think you need to kick off the next session.
It's actually me jumping the gun again. So thank you, Lev. That was really good. Just to kind of touch on your last point there. So one of the things that you mentioned the transparency, and also making sure that what our clients are doing is right for them. And that's really important, because there are so many different options and different brokers out there who might have different thoughts and opinions, but that doesn't necessarily mean that what they're doing is always going to work for you. One of the cases that I've seen come up multiple times recently has been regarding life cover. So one of these examples was recent, and I had a client who, sorry if we could, lovely. So she was age 31 and she just purchased her first property with her partner, and she was looking to source some life cover. we were able to find cover at £41 a month, and she did have some ongoing tests, so we had to say to her, wait for 6 months and then we can get things underway. In the meantime, she'd also spoken to another broker, which happens so often in this industry, and that broker actually managed to find cover for £20, which, when you look at numbers on the paper, I would definitely rather pay £20 a month over 41. I always like to see what else is going on and what these other brokers are advising, so I will always ask to see who the policy's with. And in this instance, when I reviewed the policy, it actually wouldn't pay out for anything related to lupus. So when you think of all the different conditions and all the things that I suppose a GP could say relate back to lupus, what are you paying for at that point? And she wasn't aware of that. She hadn't been advised by her broker. So I spoke to her about it, and in the end we decided against the alternative policy, because she wasn't aware of the risk, and for her she really would have been paying for something that isn't beneficial. So it's really important to know that yes, there are always options out there, but this is a prime example that, as I say, I've seen at least 5 times in the recent months where someone is being sold something over being cheap rather than being right for them. So what do we mean by life cover, and why would you need it? So it's insurance. It's insurance to protect yourself in the event of death, but it can also be used for a variety of different things. So I'm also going to touch on some of them a bit later on. It's in the same way that you would always look to insure your house, your car. You hope that you never need it, but it's financial security there in the event that you do. So why would you need it? So often it occurs during big changes to your life. So maybe you just bought your first house, maybe you've had a baby, you've just had a promotion at work, anything that could be a financial burden on either yourself or your loved ones, and it's to give you peace of mind. So I think I've jumped ahead. If we could just next a couple of times. There we go. So also to ensure that debts are repaid. So maybe you've got some credit cards or things like that that you wouldn't want to pass on in the event that anything happened to you. And also maintaining financial commitments. So these days we see a lot where family are helping out with perhaps school fees. Often we see grandparents, parents where they've inherited some wealth and they want to pass it on. But what happens if they're not there? So life cover it can mention so many different things, but it's all really about maintaining the quality of lifestyle that your family are used to. And as I say, it can really give you peace of mind. So another type of life cover is income protection. Now it works slightly differently, because income protection will pay out in the event that you're unable to work, and it will typically run up until retirement age or until you're fit and able to return. It can be due to long-term sickness or injury, and it will pay a monthly benefit, as I mentioned, until you can return to work. It will typically kick in after a deferred period, so that could be 1 month in, 2 months in, or it could be 6 months down. And what people tend to do is to ensure that you have something in place for when your work stops covering you, for example. Perhaps you're self-employed and you don't have that protection there. And it's really important to know that all of these look great on paper, but again, you need to speak to someone to see what's right for you. Are you paying for something that is worthwhile? And I do have to say, it's not something that everyone can get. So that's why it's worth speaking to a professional who will kind of guide you towards it and see what's available to you. Okay, next slide, please. So life cover with lupus. So we can go. So some of the questions that I get asked when I'm on call is, does lupus automatically stop you from getting life cover? And the answer to that is no, it doesn't. There are often things that you need to go through. So perhaps an insurer will ask to see your GP report, speak to your doctor, or run some medical tests on you. And this is all fairly straightforward, and it's something that is there to make sure that what they're offering is right for you. So one of the main things is always be as honest as you can. So tell us everything, and we will be able to filter out what is required and what isn't. Another question is can I still get covered through the high street? So what we see is a lot of people think that they might end up paying hundreds and hundreds of pounds for a policy, and that's not always the case. It's with a lot of what we've seen that's come through over the last few months, it's actually not that much more expensive. However, it depends on your individual circumstances, and that's why it's good to have that conversation. Go next, please. So what's the cost to you? As I mentioned, it really varies depending on what your personal circumstances are. But I'm going to cover off in just a moment some of the things that are considered when it comes to costing for life cover and what that can look like. And again, with what we do, so we will run through a medical questionnaire. We'll talk to you about your recent medical history, how the lupus impacts you. And we'll also look at things like what do you do for work and a few other situations. If we could go next slide, please. So what do we need to know? When was your initial diagnosis? What type of lupus have you been diagnosed with? You're currently undergoing treatment on any medication, and how does lupus impact you on a day-to-day basis? Now, with everyone that I've spoken to, they say, I don't know, because it's not the same from one day to the next. And that's where we want you to feel as comfortable as you can with us, because the better that we understand how you're impacted by it, the better that we can help you. And the other one to that is, when did you last experience symptoms? And it can be very ambiguous. So there are some people that might have had a cold recently and they say, we're not sure whether that relates to lupus or just it's a miserable time of the year where everyone's getting ill. And it's really important, as I say, we just have these conversations and we see how we can help you. So there are a multitude of different things that could impact the cost of cover, and I won't sit here and just read them out off the screen, but you can see there what we need to run through. So ultimately what you'll find is that typically the earlier that you get cover in place, it will usually be cheaper. Again, things like smoking, alcohol consumption, they can all impact what you pay, but the more honest you are, the more we can refine that. And it's all about making sure that if you do pay for cover, that you're paying for something that will benefit you. If we can go, so asking the right questions. So we had someone who they'd recently sourced their mortgage elsewhere. I wasn't offended by it at all, but they got in touch to talk about life cover. Their mortgage broker had said they wouldn't get it due to having lupus, and all we did, we had a conversation. We went through the medical questionnaire with the client, and actually they were offered terms, so they were accepted for cover. And yes, it was a little bit more expensive, so it was £32. So it was 50% more expensive than for someone that wasn't diagnosed with lupus. So that hopefully goes to show there that yes, at times it might be more expensive, but it's not the hundreds of pounds that might be out there and getting thrown around. So moving on, mortgages. So I know this was something that was asked about quite a bit. So can you still get a mortgage with lupus? Yes. And really, what do you need to do differently? Well, in terms of your mortgage application, there's not a great deal that you need to do. It's similar to someone without lupus. But what I would say is important is making sure that there's a contingency in place and that you've thought about what you would do if you were to have a flare up or be unable to work for a period of time. So I think the main advice I can give with regards to mortgages with lupus is, what is the contingency in place? And hopefully that's something that we can help with. So do I have to tell my mortgage provider about my condition? Again, no, it's not something they ask about. They want to see what you're doing for your employment. And again, it's where the conversation can be had around, are you able to work consistently at the moment? Have there been any instances where you perhaps haven't been able to, you've been off work for the last couple of weeks? Talk to us and we can work through that. And again, should I do anything differently? No, just be transparent. And I think these are the things that tend to worry people the most, because again, it's the questions that I get asked all the time. Now, if any of you do have a mortgage already, and perhaps you've gone through a bad patch with a flare-up, or work hasn't been great at the moment, there is something called the Mortgage Charter. I'd be more than happy if anyone did have any questions about this to talk to you about it at a later date. But it is basically a scheme between the FCA, which is the Financial Conduct Authority, and the government. What about 97% of mortgage providers are doing is basically agreeing to help you out with different solutions if you're unable to meet your payments for a period of time. I won't go through them all, but typically things like payment holidays, perhaps switching to interest only temporarily. And so there are options out there, and it's just about talking to us and exploring everything that we possibly can first to see what's the best direction for you. So I'm now going to pass you over to Elliot, who's going to talk about cash flow modelling. Thank you.
Yep, thank you, Matt. And yeah, for the next part of this presentation, I'm going to summarise how we use cash flow modelling with clients as a useful tool to help them plan for their financial future. So in simple terms, this is really just a piece of software that projects one's future financial position based on the current circumstances and a series of assumptions. So to start with, we'll input details of savings and investments, income and expenditure, as well as any liabilities. And we'll consider any regular savings being made, so regular savings into an ISA, into a pension, including those made by an employer. And if there's any planned expenditure coming up, such as needing to buy a new car or replacing an old boiler, we can enter that into the model as well. We then project this position into the future based on a range of agreed assumptions, such as inflation, likely growth rates, for all the savings and investments that one holds. And the tool helps us demonstrate what happens if, for example, expenditure goes up or income falls if you can't work due to ill health. The next slide, please. And the model basically looks at normal circumstances, so the way things are expected to pan out based on historical returns, but we can also demonstrate what would happen in the event of extreme market conditions, such as the falls in the global financial crisis in 2007-2008, or during COVID. And there's a number of ways in which cash flow modelling could be helpful. Perhaps the most obvious one being whether or not someone is going to have enough money in retirement. In very simple terms, what happens if you run out of money in your lifetime? And is there something you can do to stop it happening? But the model can be effective at all different stages of your life. And it can be just as important for savers who are building up their assets. It might demonstrate a need to save more at an earlier stage of one's life, or perhaps reduced expenditure. On the other hand, it might demonstrate that there's going to be an abundance of assets, and that in turn could raise questions about inheritance tax. So there might be scope to demonstrate how to gift assets to children or grandchildren, or perhaps give to charity. Now, clearly this is not an exact science, and markets do perform better or worse than expected. Unforeseen circumstances happen that clearly can have an impact on expenditure and have an impact on one's ability to save. So it's very important that we revisit the model on a regular basis when we have our client review meetings, and certainly at least annually. So on the next slide, I'm going to have a look at how it looks in practice. And there's a lot of detail on this slide, so I'm just going to try and summarize at a high level what you're looking at here. And this is a cash flow projection for a single client aged 40. And let's call her Jane. So to start with, we input Jane's financial circumstances into the tool. And Jane has managed to save a fair amount since she started work after leaving university. She has 20,000 in cash, represented by the blue bar, and 100,000 in stocks and shares ISA, which is the red bar. She's also been contributing to her company's pension scheme and has built up a fund of 50,000, which is the yellow bar. Now, Jane is currently working and she's got a salary of 50,000 a year, so she earns about 3,200 net a month. Now, we've encouraged Jane to be sort of really accurate with her expenditure and estimate what she thinks she spends each month. And she thinks it's about 3,000, so she has a surplus each month of £200, which she's paying into her ISA. Now, her company has a company pension scheme. They're very generously paying 5% of her salary into the scheme, which she's also matching. So she's got £10,000 a year going into the pension. So Jane's in a financially stable position. Her income exceeds her expenditure, and she's saving for her future. So now we'll look into the future, we'll make some assumptions, and we're going to say, for the purposes of this cash flow, we'll assume inflation will be 3% a year. Now that's lower than it is at the moment, but higher than the Bank of England's target of 2%. And we'll also assume that her cash will generate 3% of interest, and that her ISA and her pension will grow at 5% a year, so 2% in excess of inflation. Now Jane's planning to retire at 65. So what you can see here is that until she reaches age 65, her overall wealth will grow. But once she retires, clearly she's going to start drawing an income from the pension and the ISA to supplement her state pension, which, by the way, only kicks in at age 68. There's a 3-year period that she won't be receiving the state pension. And what we can actually see here is that in retirement, her assets will diminish quite sharply. And in this case, she's due to run out of savings at age 88. So we could demonstrate with Jane that there are very small changes that she could make now. Perhaps save a little more, perhaps spend a little less, increase her pension contributions, which would have a material impact on whether or not she could run out of her funds at age 88. And as I said, this is not an exact science, so we will review this with Jane every year at her annual review meeting. So for the final part of our presentation, I'm going to talk about pensions. And I think, as Rachel said at the beginning, we're chartered financial planners, and it is one of our favourite topics of conversations, even if it's not everyone's cup of tea. But we feel there's several reasons to save into a pension, which ultimately is there to provide an income in retirement. And firstly is tax relief. The government provides tax relief on pension contributions at your marginal rate of tax. So if you're a basic rate taxpayer, you receive tax relief at 20%, and if you're a higher rate taxpayer, you receive relief at 40%. So in other words, a basic rate taxpayer, for every £1 you save into your pension, it actually only costs you 80p. And secondly, the funds within your pension grow free of tax. There's no tax to pay on the income or the gains within the pension. Now, this may all sound quite simple, so why do you need a financial advisor to help? Well, part of what we do is to make sure that the investments within your pension are in line with your risk profile and, of course, aim to meet your objectives. And your objectives might be to have the same quality in life in retirement as when you were working, or you might be targeting a specific level of income in retirement. We also help clients to calculate how much they can contribute to their pension, how much they should be paying in, because there are limits as to how much you can pay into your pension and still receive tax relief. Now, the limit in any tax year is the lower of 100% of your earned income and the annual allowance, which is currently £60,000 a year. Until this tax year was £40,000. And you can also carry forward any unused allowances from the previous 3 tax years. But the total cap can be reduced if your income is above a certain level. So it can be quite a complex calculation, which certainly does require financial advice. And we always say it's important to try and pay as much as possible into your pension as early as possible, particularly if you're worried about perhaps not being able to work in the future indefinitely. And as we've seen, having lupus may impact on the amount you can work in the future. So really, the sooner you start to build up your pension funds, the better. And I'll demonstrate that shortly with an example. But, sorry, previous slide. Yeah, next one. So in retirement, there's a lot of other very beneficial aspects to a pension. And the first one that perhaps not everyone realises is you can access your private pension from age 55, albeit this is due to go up to age 57 in 2028. And you don't have to stop working to draw your pension. You can carry on working and still take your pension at age 55. And this is particularly useful if somebody's worried about not being able to work perhaps until state retirement age. So the fact that you can access your pensions considerably earlier than state pension is a big benefit in many cases. Now, we often see clients approaching retirement who've accumulated several pensions over the years, perhaps from different jobs. And it's often an opportunity to consolidate these into one policy, to simplify your financial affairs and then draw the required income in retirement. And our job as financial advisors is to review existing pensions so that any consolidation is in your best interest and right for you. Now, when you start to draw funds from your pension, this is known as crystallizing a pension, at which point you can take up to 25% of the overall value tax-free. Now, while there might be certain circumstances where tax-free lump sum is needed, often that's not the case. And we see many clients who simply want to draw an income in retirement as efficiently as possible to meet their needs. So our role as financial planners is to identify what we feel is the most appropriate way of drawing an income for that client. And there are typically two approaches to income in a pension, and these can be quite flexible as well. So the main options are really buying an annuity or going into what's called income drawdown, or indeed a combination of both. And I'm just going to explain very briefly what these are. And the annuity is, in very simple terms, a policy that's guaranteed to pays a guaranteed income for the rest of one's life. And it's purchased from an insurance company using the accumulated funds in your pension. Now, there are a lot of options, such as whether to include income that's increasing with inflation, or whether to include a pension for your spouse. Now, historically, annuity rates have been very low, so they haven't been so high on the agenda. But in recent years, annuity rates have gone up and they are becoming much more popular. And also, if somebody is suffering from ill health, you might be able to get enhanced rates and better returns than you would on the open market. So it's certainly worth getting a quote for an annuity and declaring your health conditions to see if that gets you a better rate. Whereas under income drawdown, the pension funds remain invested, where they're subject to market fluctuations, but income can be drawn as and when required. Now, if you've already taken your tax-free cash, then the income is taxable at your marginal rate. But if you've not yet taken your tax-free cash, every income payment could be split. So 25% would be tax-free and 75% taxable. So it's quite an efficient way to draw income from a tax perspective. But also you have greater flexibility with income drawdown as to when and how much income to take. And of course, if your circumstances change, you can change your income level accordingly. And it's also worth mentioning that there are attractive death benefits to a pension. So a pension that's in income drawdown can be passed on to your beneficiaries, who in turn will receive a pension. Now, this could be children or grandchildren or even a charity. And they can then draw on the pension funds as a lump sum or a regular income. So it's not lost in the same way that an annuity, when one passes away, an annuity would typically cease unless there are guarantees or a spouse's pension built in. And you can opt for a combination of the two options, so income drawdown and annuity. So you have some of your pension funds paying a guaranteed income and the rest giving you a bit more flexibility. And one last point to mention about pensions, which is sort of gets us as financial planners quite excited, is they are outside of your estate for inheritance tax. So what that means is if you never need to draw on your pension, it can be a really useful way of sort of cascading funds down to the next generation and saving considerable money on inheritance tax. So obviously pensions are pretty complex and it's always important to seek financial advice. Now, final slide for me, and there's a lot of detail in here, so I'm not going to go through it in a great deal of detail, but what this does demonstrate is the importance of funding a pension as early as possible during one's working life. And what we can see here is somebody on a 50,000 salary, and what happens if they start making pension contributions at age 30, 40, and 50. And we'll assume here that the investments grow at 2% above inflation, so like with the cash flow model. And the tables on the right are showing the projected pension pot when somebody reaches age 60. The table on the top looks at a situation where somebody doesn't have any existing pension funds at all. And the table at the bottom just shows where you've built up pension funds for a total of 100,000 at this point in time. And what we can see here is the powerful sort of impact on tax relief and the tax-free growth. So, a person aged 30 who is to make 5% contributions into their pension would find that by the time they're 60, that pension pot is 103,000, and clearly it's doubled if they were to pay in 10%. And clearly, if somebody already has 100,000 in their pension, and they were age 30 when they start to pay 10% of their salary, that pot would reach nearly 400,000. And obviously, as you're starting later in life, at age 40 or 50, the numbers are significantly lower. And it's also worth noting that the contributions themselves, here we've got a 50,000 salary, they're not such enormous amounts to pay. You know, the 5% contribution is costing 167 a month net, and the 10% is paid net at 333, with obviously the government topping it up to the full gross amount. It's also worth pointing out that if you're a higher rate taxpayer, you can then obtain further tax relief via your tax return. So really that was a very quick, high-level summary of pensions, and certainly why we recommend paying as much money into them as possible and as early as possible in one's life. Now that brings us to an end of our slides. So I'm going to hand back to Rachel, who's going to host our Q&A session. So thank you very much.
Thank you so much, everyone. That was really interesting. Whistle-stop tour, lots of information to take in. So I'm sure people will be heading back to look at it again another time. So I'm going to start with a question that we got in advance, and then I'll have a look at some of the ones you've submitted live. So one shorter question is, do companies or insurance policies at various times take account of how lupus affects people differently and if they're on different treatments? Because they were wondering about how that affects what products they might be able to get.
Yeah, so I think I'll take this one if no one minds. Typically, it's on an individual basis, so that's why it's really important that we encourage people to be as transparent as possible and tell us as much as they can. Because yes, what might not sit well with one provider might be okay with someone else. So it's very much on a case by case and provider by provider.
Great, thanks very much. So one person in the chat has asked what you're thinking about retirement planning, although this has been covered a bit just towards the end, about your broad thoughts. So they're using their pension, getting max contribution, stocks and shares ISAs, but the concern is that their health might decline and they have to stop work earlier than planned. And then they wouldn't be able to access their pension yet if they weren't old enough. That was similar to a question we got in advance in, would you advise putting money in a pension pot or a savings pot if you might have to retire earlier, then you won't get access to your retirement funds and all that kind of thing?
Yeah, I mean, I'm happy to take this. I mean, I think the simple answer is there's not one answer that fits everyone. You know, we'll always look to clients on a case by case basis, and in an ideal world, you know, funding a pension and an ISA covers both sort of aspects of having access to the funds sooner rather than later in terms of the ISA, whereas the pension, you know, as I've said, you can't access it to age 55, albeit it does have better tax benefits in the form of the tax relief and the inheritance tax aspect of it. But I think, you know, what we try and do with clients is say, look, you know, if you've got X amount of surplus income every month, maybe there's a way of, you know, dividing that, putting some money towards the ISA so that you know you can access it if you need to. Obviously, the ISA itself is very tax efficient because it's a tax-free wrapper. So we'd always encourage our clients to invest into an ISA, but, you know, putting some money aside for the future as well into the pension, and, you know, having that hybrid of the two. And I suppose part of our job is to say, well, you know, if you've got X amount to put away each month, how much do we suggest goes into the two? And it really is, you know, decided on a case by case basis. But, you know, it is important to remember with a pension, particularly for somebody who is young, you know, it is a long-term savings vehicle. And, you know, whilst we love pensions and, you know, we encourage you to build up your pension funds as much as possible, we do appreciate that you're locking funds away for, you know, a considerable amount of time. And, you know, we'll often see clients who are maybe in their 20s or 30s who are, you know, thinking they might want to buy a property or they might need access to their money. So, you know, whilst it's great to lock money away into a pension, it's not always appropriate for everyone. So it's really the case by case basis. I don't know if Rachel or Lev or Matt want to add anything? Or
I was just going to echo what you were saying and what Lev said earlier about financial advice will basically help you decide how much to pay into each one, and that's where the cash flow modeling can really help, because you can actually test out what happens if I retire at this age or that age, and then you can see the impact of the different accounts. So yeah, it can be a conversation can really help you illustrate that for yourself.
Great, thank you. And I suppose a similar, well, kind of related question about thoughts on contingency planning for periods of unemployment due to ill health. Again, when you're not yet at a stage for retirement, perhaps it's shorter term or you're not quite old enough to access those funds. Kind of your experience around employment or illness protection products with lupus, and kind of what kinds of things are out there for people.
Yeah.
So that's again where things like income protection policies can come in. As I said in my little bit, they're not necessarily right for everyone. But it's also really important that people know what they have with their employer already. So a lot of companies will offer employee benefits such as long-term sickness, so income protection if they're off work. And it's really important that as part of the financial planning process, we know what's already available to them. So we do see a lot of people that until they've actually sat down and had that conversation with their line manager or HR manager, they don't necessarily know all of the benefits that their company offers already. So that's always where I'd say first point of contact should be.
I'll just add, as Matthew said earlier, it's important not only to know what you have, but what the terms are. I was actually speaking to a client today who told me that she does have income protection provided by the employer, but when I asked what the terms were, she couldn't tell me. She actually subsequently emailed to confirm it's 13 weeks deferral period, so it means that she'll have to wait for 13 weeks to receive the first payment. It's 50% of her salary, so it may or may not be enough to cover her essential needs, and it's only for 5 years. So again, will it take her to state pension age, or will it be sufficient? So that's, I suppose, the questions you will be asking, or your advisor will be asking you, and you decide on the strategy. But yeah, this is today's data if you wish.
I'm just going to add one more point, and that's sort of when we meet a new client and we're looking at their overall assets and trying to work out, you know, how much is going to ISAs and pensions and everything. Really, a starting point is always, what do you need as emergency funds? What do you need to hold in cash before we even start talking about investing into, you know, riskier assets? So you mentioned sort of, you know, if somebody can't work and maybe they don't have an income protection policy in place, it's making sure that you have funds as an emergency, and, you know, whether that's 3 months or 6 months income or monetary amount in mind, you know, we'd always, as a very starting level, suggest, you know, make sure you have cash for emergencies and for unforeseen circumstances.
Thanks very much. This is quite a general question, but someone was wondering if you had any advice for young people who have been diagnosed with lupus and are trying to think about what the impact on their finances might be.
I would say it's probably very similar to the advice that I give to all young people. I probably do a disproportionate amount of appointments with younger clients, and it's to actually seek advice. The younger you are, as you saw from Elliot's slides, the younger you are when you start this, lupus or no lupus, the better your outcome will be, because compound interest can massively change things. So I suppose it's a little bit of a cop-out, but my advice for young people diagnosed with lupus is the same of actually start young, speak to financial advisors. Lots of people don't reach out until they reach a certain level. We have a lot of people coming to us with imposter syndrome, thinking that they're not important enough to speak to us. But there are different advisors for all different stages of life, and there are lots of different ways to start your financial planning. So the younger you can start, the better it is.
Thank you. And kind of a similar but the opposite way around question. Someone wants to know if any advice for people who have lupus, may have worked for a while before lupus hits, they could already have some savings or a small pension pot, and how, if this is different from your advice for young people.
No, I suppose it wouldn't be that different. I guess it's always useful to know what you already have. So that's kind of echoing what we've already been talking about. And yeah, just understanding what the terms are. So yeah, we hear it. I'm sure everyone will nod now. We hear it quite a lot. I have a couple of workplace pensions from previous employments, but I don't know where they are. I don't know what they're invested in. So it's reviewing your current position, understanding it, and it may happen that at that particular point there will be no advice. It may be the case of you're in a good position, let's leave things as they are, or there may be an immediate need to actually take action, i.e. consolidate pension, move them elsewhere because it's an old contract with high fees. Yeah, I'm afraid I'm going to use the phrase which was used already by 3 other presenters. It's case-by-case basis.
I think what I've taken from all of your talks and answer to your questions, that it's very individual, but having lupus doesn't preclude you from thinking about mortgages or pensions. There might be additional things to think about, and it's important to be transparent and honest about those so you can get the right thing for you that works for you no matter what comes up. And that can include things to do with your mortgage, to do with income protection, all sorts of different bits and pieces. And also that maybe it's one of those, the best time to start was yesterday, the next best time to start is right now. The earlier the better can really help you think about these things moving forward. Before we finish off today, I just wondered if you had any key takeaways you'd like people watching to come away with, or any key bits of advice you think would be useful for people.
I think all I'd say is often when people think of talking to a financial advisor or anyone about their finances, that it's a really high level conversation, and it doesn't necessarily need to be. It can start off with being just a very generic chat, and often it's just getting to know that person, and the better that we do that, the more we can help.
Yeah, and I'll just sort of echo that and say, you know, clearly we can help in a lot of areas or one specific area. You know, we deal a lot with clients on a very specific case-by-case basis. It might just be, you know, they want advice on their pension, or they want a specific cash flow model done at a particular point in time, but there's no real, you know, it doesn't have to be everything. It could just be smaller doses, and you know, we're happy to have those conversations with clients to meet their needs, and you know, we're here to help.
Yeah, I completely agree with Elliot, and I guess my point of view from his, we consider it a relationship, and with any relationship it evolves. Initially, perhaps we can start with very generic guidance, and then we'll learn a little bit more about each other. That's the way I see lots of my relationship with clients. It just evolves over time naturally. And again, kind of echoing to what Matthew said, the more we know, the better we can help. But yeah, I guess I accept that initially perhaps we will not know everything, and that's fine. And it does take time to earn the trust, and we're totally prepared for it. But yeah, we can help you indeed.
Well, thank you so much for your time and your hard work on this today. I know that I've definitely learnt a lot myself as well. Just a quick note to people in the chat that asked about collecting email information. That option shouldn't have been on for Zoom. So if we do get your email address, we'll delete it. You're not being added to an email list. It's possible it was Zoom adding you to their email list. And if that's the case, you should be able to just unsubscribe yourself. We were talking before this started that Zoom sometimes has a mind of its own, unfortunately. But yeah, we're not collecting your email address for any purpose. But yeah, thank you so much everyone for coming today and for your time and taking the time to answer questions. We will let you know when this goes live on our YouTube channel, so you can have a look at it again later, just to take some of all the information in a bit more slowly as well. But yeah, thank you so much.